Hi, everybody. Welcome to our webinar. My name is Scott Zimmerman, and today we're going to be talking about business planning to keep top talent in a post-COVID world. So, why is this important? It's always been hard to attract and keep top talent, and especially with the world the way it's been with COVID. It's a whole different landscape. Employees used to come into work every single day. And now employees are working from home, and employees are looking at things differently. It's really hard to attract key employees because there's not employees really have choices of where they want to work nowadays because the way that everything's changed, and they're looking for different options and different ways of how they can work. They're looking for more of a balanced lifestyle. Today we're going to talk about how to keep and attract these key employees, and going forward, I'm gonna moderate this. Again, my name is Scott Zimmerman. I'm one of the partners at CorpStrat. This is my 32nd year in business, and CorpStrat, we specialize in all forms of employee benefits, whether it's health insurance, dental, vision, 401k, all aspects of employee benefits. Different insurances for business owners, which we're going to talk about today, HR and payroll. Along today is one of our business partners, Marty Levy, is going to be leading the talk. Marty is a CLU. He founded CorpStrat over 30 years ago. He's a certified chartered life underwriter. He's a registered health underwriter. He's a certified annuity analysis and holds a certificate of long-term care. Marty is a frequent contributor to many different industry publications and is always he's a life and qualifying member of the $1 Million Roundtable. It's an elite organization representing the top 1% of advisors in the insurance industry. Also with us today is Brendan Barkate. And Brendan is one of our consultants that works with us day to day. He's become one of the most prominent case design consultants in the country. In fact, in 2015, he was recognized nationally as Life Health Pro's top 30 under 30 amongst all the peers in the industry. He's the top of his game, and today Brendan sits on several boards of life insurance carriers. He helps design plans for all the things that we're going to talk about today. Ways to keep and attract and retain key employees. Brendan is going to be, he consults with us on a regular basis, and he works with high net worth individuals and business owners. So we're going to get started. Questions and answers, if you could type them in. We're going to answer all questions at the end. But we'll get started. Marty.
Thanks so much, Scott. There's never been a time that there was more things on the mind of a business owner than the past year and few months has been. I'll take a shot at just highlighting some of the issues that have been facing every business owner. Starting with COVID, as early as Tuesday this week, the Cal OSHA board actually deferred the vote on discussing how employers can return to normal. They've put off a vote until June to mirror Governor Newsom's order to basically relieve us of masking and spacing. So we're really not going to have guidance about what an office will look like for maybe another week. But that's just the tip of the iceberg. I mean, in terms of workplaces, the questions about social distancing, masks, about, number of people in offices, that's been an ongoing and daily challenge. Adding to this is, the question about vaccines, whether we can mandate them, whether you want to ask about them, whether you're going to incent, whether you can actually legally ask employees that question. That's just one of the things that's been on business owners' minds. I mean, remote work, can you run your business effectively? Can you measure productivity of your employees? The other thing that's going on right now is part of Biden's stimulus package has been a granting of free COBRA to certain people who you may have fired in the past year or laid off due to COVID. And carriers are now just responding the Department of Labor's guidance about how to communicate the offer of this free Cobra and who's going to get it. So look in your inbox for communication from us and the carriers about your compliance requirement. You know, you've got PPP loans out there that you're hoping to get relieved on, and maybe even trying to figure out your employee retention credit. You know, you got your employee lease, your lease building, about what your new reset looks like if you're going to renew your lease. And then you got a host of HR challenges, not the least of which is, do your employees want to return to the office, or do you want them to return to the office? So I think what we're looking into is an unprecedented time in being an employer, maybe what we might call the 2021 great turnover. You know, during COVID, people were hunkered down, so they were resistant to want to change. But I think people are rethinking their options about what a job, what employment looks like. I think that they've seen that COVID can enable them to potentially be remote. We saw Amgen 2 weeks ago basically become a complete remote company. And so, you know, we have a landscape where employees are going to look for different things from their employers. And so the question I think we want to talk about is, you know, how do you compete for talent? How are you going to attract, reward, and retain? I said it's a jungle out there. It definitely is. I think there's lots of things that need to be tackled. You know, one is employers need to rethink not just what they offer, but how they offer benefits. I'm sure that as you are recruiting and talking to your staff, people want to know not just what their job is, what they get paid, but the next question is, what do you offer? And if you are an employee, you don't have the ability to discern between Aetna and United Healthcare and Anthem. What you do know is what your co-pays are, maybe what your deductibles, but more importantly, how much you pay from your paycheck. And so companies over the last 10 years, especially smaller companies, have had to slim some of their benefits, reduce some of, let's say, their offerings because of the rising costs of health insurance plans. And so the small companies are most at risk here. When I say a small company, I'm talking about firms under 100 employees in particular, who've graded down from plans that might have been platinum or gold to maybe silver or bronze plans as baseline plans. So it's important that companies stop at mid-year right now, revisit what their packages look like. The reason to do it now is you do it when the market is not open enrolling everybody. And then once you've evaluated how you enhance your offerings, you have to take some time to work with your HR team to package and promote these things, because prospects for employment are largely, they don't know what they're looking at. You need to have tools to show people what it is you offer. And then lastly, on this point, I talk about digital delivery. You know, the virtual workforce has required every company to adapt something that looks like a human resource platform. And so if you're not on one of these platforms where you are integrating your onboarding, your time and attendance, your benefits, your communications, the train truly has left the station on this issue, and your bags are on the dock. So be sure you're talking with somebody like us about what is a human resource system and how it works. I want to touch real briefly on retirement plans, because it's a part of most companies' package that either they have or now are required to offer. Most companies think that offering a plan does the trick, and we'll talk a little bit more about it in a moment with Brendan, but I want to remind people that the larger your firm is, the less likely that this plan can benefit not just your staff, but let's say you're starting 5, you're highly compensated. And so when you talk about valuable people in organizations, these are people getting the least benefit from a qualified 401k. People who are earning 130,000 a year or more, or they're a 5% owner or related to somebody who owns 5%. These people may not even be able to put in their max unless you do things like safe harbor or profit share. So don't just assume that having a 401k satisfies your need to build a benefits portfolio that's vibrant. I wanted to throw a couple of quick ideas and then I'll pivot to my partner, Brendan, about what you can do and what I recommend you do. I think it's important that you expand on your benefits. Even things like pet insurance are becoming very popular. Look at pre-tax planning. Look at products like medical expense reimbursement that maybe you can do something special for a select class of people. Explore things over and above qualified plans like golden handcuff arrangements. Some of them are referred to REBAs. If you're large enough, you could do true deferred compensation. A lot of complexity there, but certainly you have to revisit the contributions for your medical insurance, the part where people pay out of their paychecks. Largely, they're looking for you to offset that. Obviously, insurance products are powerful for people who need protections, life, disability. But I think the most important of all is just understanding the whole new paradigm of the work-life balance that your employees are going to be asking you about and expecting you to accommodate. With that, I'll ask Brendan to step in and thank you.
Marty, thank you. And again, I couldn't have said it better. I think today it is a jungle out there. I think companies are searching for key people, holding on to them. What do we do with them? I'm going to get through some of those stats today, but and I'm going to kind of echo some of your thoughts because I think you were spot on. Again, I think most business owners, folks that are tuning in this phone call today, understand here in California and management competing for labor. We all understand the importance of basic benefits for most. And, I'm going to use this analogy, and Marty used it too, our starters and our bench players. California, to get good talent or average talent, you're going to need healthcare, pretty much to attract anybody that has some form of skilled labor. And again, I think without those benefits, you're not going to attract much key talent at all, or any average talent. And kind of going into this next slide here, I'm going to kind of just pull up some basic statistics to say to that. So the pandemic has really helped spur a lot of studies in workplace environment. I'm sure Marty and Scott, you guys know that as well. In 2019, about a quarter of the workforce quit and wanted to go work somewhere else. In last year alone, 35% of employees in the workforce went to go look for a new job. I mean, that's unheard of in the data that's been coming up with this pandemic. So one thing that we're learning is how expensive it is to lose somebody. If you looked at some of the big data reports out there, it's going to cost an average of $15,000 just to lose a bench player, right? A Mark Madsen, we're going to lose $15,000 per employee. So to quantify that, and there's a decent stat here, basically it says, look, if you have an average company, right, and you're going to lose 37 people a year, that's going to cost you guys about $550,000 in just hard costs of labor. Companies that rate themselves positively, right, that lose less employees, right, 26 or fewer each year, they're still going to lose, right? But again, they're going to lose less, right? So what the big thing is telling us is lose less employees. Instead of losing $390,000 in hard labor costs to our rank and file bench players, what if instead we looked at it differently and spent a couple $100,000 and helped retain and drive those numbers down? So one of the talks we're going to talk about today is not just retaining your average talent, your average bench player, but try to figure out, all these statistics get magnified the more important the employee is. So I I'm going to talk real quick about kind of a micro and macro effect of all this type of stuff. And I know those are really fancy words, but we all can see that data shows us that on average, reducing the number of employees that turnover saves you guys money, right? Saves any business money. The less people that walk out the door against you doing, you're going to save a lot more money. The macro effect of that is, look, okay, we know big picture, little picture, we're going to lose some money. We get that. But the big picture is the top line revenue impact. You lose 10% of your revenue drivers and you got a business making $5 million a year. That's going to create a substantial damage to revenues of your core peers. People are going to be picking up slack from one another. You're going to have the receptionist doing accounting and the accounting doing HR. And so you're going to be put in this pickle on a constant basis, work stress, that kind of stuff. Headaches. We own an insurance consulting organization. We have a couple people leave every year. I mean, the amount of headaches and stress that drives, or a combination of all of those things, is damaging. It hurts, right? So one thing we want to talk about today is not just the basic benefits that every company needs for your rank and file, but what can we do for our key people? And again, I just wanted to kind of touch on what it goes through hiring a person as a reminder of the pain it takes to find somebody that makes $100,000. I mean, you're talking about months to find somebody that can do skilled labor like HR, accounting, sales. The costs, try to find them, relocate them, signing bonuses, headhunters, their time, your time, work-life balance. I think Marty touched on that a little bit earlier. It's not just like having an HR company and somebody shuffling in your door, but the amount of strain it takes on your company's infrastructure to actually bring somebody in that's meaningful to help you guys make some money. So kind of moving through that here is, the last thing I would say kind of before I get into what is kind of highly compensated employee is recruiting. So if you kind of look here at our next slide, what do people want, right? How do we get them in the door? What's on their mind? So I went to some big data and did some research. Retirement. How are you going to compensate me later? You can look at all these other things. 401ks, right? Everybody has that. That's not a differentiator. So if you look at the main statistics and the main big data out there, where are the best employees, the best talent? Where are they searching? What's on their minds? What do they want? Majority of them want some form of a pension, some form of retirement account. It's got to kind of make them sign on with you. So the recruiting tool everybody wants is, how do you recruit key talent that favors them, right? Retirement. So that kind of leads us into our highly compensated employee. So if you kind of take a look at our next slide, here's what is this? And Marty, you touched on this earlier. He's your LeBron James, your starter, making $130,000 or a year or more in compensation, owns more than 5% interest in the business or a spouse. How do we keep LeBron James on our squad as long as we can, right? The key to success in a lot of these businesses, we see the data, losing employees, losing your mail clerk, a filing person, a rank and file. We can withstand those $15,000 losses here or there, right? We obviously want to try to eliminate them. We know we can't get rid of that problem altogether, but that problem turns into a monstrous problem when we start losing our starters, right? When LeBron James went from Cleveland to the Lakers, Cleveland won 25 games, right? How do we kind of take some of those types of deals and move them and learn from what other teams have done to be more successful? So what is the big problem out there? And it's the highly compensated employee problem. And there's a graph on that screen that I wanted you guys to kind of see. To somebody that's making $200,000 a year, okay, and can only put $7,000 in their 401k, that's not a differentiator, right? That highly uncompensated employee is actually being discriminated against because he can only put a little bit of money in there and he's not going to be able to retire. So what makes you think he's going to come work for you? Where an example is $70,000 employee putting in $6,000, that's going to get them much closer to their retirement income goals. So for our low-level employees, the Social Security and their 401k, that's going to be enough for most of them to retire. But you have somebody making $200,000-300,000 a year. There's a giant gap, or this chasm that exists between what they need and what you're offering. So again, going into kind of traditional qualified plans and 401ks, it's not enough to keep the starters on the court. I mean, the challenge is to try to come up with, like Marty said, profit sharing, ESOPs, other types of qualified plans that are ERISA sponsored, is not enough. It's so expensive. I mean, you got headaches, you got regulation. It's even going to favor more of your rank and file, which you guys as business owners you love, you cherish them. But if you could, you'd rather give it to the people that you know are going to make you the most amount of money. And that's the main deal at the end of the deal. So again, also can't discriminate. I think that's one big thing there. I sat down with a cleaning company down here in San Diego the other day. They don't want to have to give the same benefits to everybody that cleans the offices, but they got 6 or 7 executives that run the business and keep profits coming. They got to hold on to those key people. So you guys do want to discriminate. You do want to kind of pay LeBron more than you pay the 8th guy on the bench. And traditional qualified plans normally can't get us there. So where does that take us? It kind of just takes us into a non-qualified plan, right? Something that falls out of ERISA guidelines, where we can slant and favor benefits to our highly compensated, our LeBron Jameses out there. And what are those plans look like? Typically, like Marty said, traditional deferred comp 409A plans, unless you're 100 employees or more and you have a full-time group of accountants to do all that and monitor that, they're more expensive than the plans are worth. So what do small to medium-sized businesses with 100 employees or less typically go? There's 3 main things that people are doing today. They're doing split dollar plans, SERPs, or sometimes referred to as supplemental executive retirement plans, or what Marty referred to earlier as REBAs, or a restricted executive bonus plan. And I'm going to kind of just touch on these really quick. There's probably an infinite amount of iterations off of those plans. But before I jump into that, I wanted to talk to you guys really quick about what changed on January 1 of this year. A lot of these plans use a life insurance element to them. Why do they use life insurance element to them? The tax advantage growth. There's a full cost recovery. So if something happens to our executive, these plans can kind of pivot off of a buy-sell agreement or a key man obligation that you may have for that person. So last year, let's say a business wanted to set aside some money and use the cash value growth inside of a life insurance policy. Now, these plans have been around forever. If you looked at every single Fortune 500 company, every single one of them has a form of deferred comp using one of these 3 strategies. Now, years ago, you say you had to put in $10,000 into a cash value life insurance policy as an investment. IRS says you need to buy at least $500,000 of life insurance on that person. And to a business owner, like, that's a lot of expense for me. That guy doesn't need all that much life insurance. I don't like this as much, but he did it anyways, right? He loved the tax advantages, the cost recovery, and it satisfied some buy, sell, and key man obligations. Love that. The IRS this year just cut that threshold in half. You only need to buy half amount of life insurance that you did last year. And a lot of people have no idea what that really means unless that's what you do for a living. So the barrier to entry into the tax-free world of accumulation, deferral, and tax-free income coming out the other side, and you can discriminate in these types of plans, right? Non-qualified plans fall outside of ERISA. That barrier to entry just got cut in half. So the fees and drags of life insurance as the underlying investment vehicle just got that much sweeter, and most people don't know that that exists. So there's a huge opportunity right now with taxes, I would say, on sale, depending how you view about taxes. I think most of us on this call would almost all agree that taxes in 10 years from now are going to be less than they are today. And if you can get into that tax-free benefit type club and that barrier to entry coming down, there's a lot of advantages that exist right now. So again, I just wanted to kind of give you guys what 7702 is. You can do some research on that stuff, but let us know, we can help you. So what are the 3 types of plans? And there's a graphic on the screen for those of you guys can see this clearly. Very, very basic. A split dollar plan is basically something that you, the business owner, own. It is in your control. You fund it. You own it. You set up a service period. Okay, so hey, Mr. Employee, you stay with me for 15 years. And at the end of 15 years, I'm going to give you this cash value asset. Okay, who likes these types of plans? Companies that want control, companies that want to attach a key employee for a period of time and not just give them that money today, because if you just give them the money today, they're going to turn around and walk out the door. So what you do is you give it to them inside of a life insurance policy, and they get the keys to it if they stay and earn out their service period with you. Now, along the way, you can give them a little bit of death benefit that they may need for their families. You may choose to keep it for yourself. That's completely up to you guys. Next slide there. How it kind of works at the end. Basically, the employer, you guys, roll the policy out to that executive. That executive says, thank you, I got $1 million asset. Now you're going to pay a little bit of taxes on that at that point. So you, the employer, get a nice, healthy, delayed tax deduction. That employee is going to have to pay some taxes. And normally what do? They take a little bit of distribution from their cash value policy and they ride off in a sunset with a tax-free benefit. What did that solve? Well, that person that needed that retirement income gap, right? That huge gap that exists today, we fulfilled that. And you guys, the employer, controlled it, funded it, and owned it on your balance sheet from day one. Going into our next one here. What is a REBA? I already touched on it earlier. Similar type of bonus, but this time what we're going to do is companies that are making a ton of earnings say, hey, look, we're going to go bonus, Johnny and Judy every single year. But we're going to bonus it to them, but we're going to have an agreement that that bonus has to go into an investment, right? i.e. an insurance policy. And there's a restriction where they can't access all those policy cash values until they hit that service period, right? Or we attach what they call a vesting schedule to those benefits. This works well for companies that want an instant tax deduction today. The con on something like this is you guys kind of give up some of your control, right? So if that guy wants to leave halfway through a service period, nothing's going to stop him, but you guys are going to get the feeling of tax deduction and you're going to put a little bit of faith that that guy's going to stay with you to continue to receive his bonus. Okay. Lastly, there's another idea out there. It's called a SERP, or a Supplemental Executive Retirement Plan. And what this is basically you, the company, are going to set up an investment for them and say, hey, you stay with me for, if you want to go to the next slide there, Scott, you stay with me for 15 years to the end of our service period, and I'm going to give you $1 million bonus. And I'm going to pay that $1 million out to you, from age 65 to 80. Okay. So now some companies will say, hey, look, we're going to just invest the money and we're going to pay it out of the company. But what most businesses would do is say, okay, we're going to start funding this liability inside of a life insurance policy, right? And build up a giant pot of money, income tax free. And then we owe this guy $1 million bonus. And so we're going to agree to pay that bonus. If he stays with us for 15 years, we're going to pay it out for 15 years. The company is going to collect income tax free benefits from a life insurance policy. And we're going to then 1099 that employee as that bonus persists during his retirement years, right? So 15 years back. So there's a bunch of different ways to do these types of plans, guys. Split dollar plans are great. SERPs, bonuses, whatever they may be. Every business has a different recipe for success. But again, at the end of the day, the problem we're trying to solve, if the only takeaway I can give you guys is qualified plans aren't enough. Non-qualified plans are so desired right now. So many people are seeking that. The big data shows that. And if we can, instead of losing our key people and continue to watch them walk out the door, the challenges of hiring them, finding them, retaining them, keeping them happy. If we don't keep them happy, it's going to cost us top line revenues. It's going to cost us hard costs. But if we instead take some of that money and spend a little bit of money today and find unique ways to hold on to our talent, keep the 2020 Dodgers intact for as long as we can, I think that's going to give you guys a lot of success moving forward. So here's just a little bit of example of that on the screen. And Marty, I'll pass it back over to you.
Yeah, I thought that we'd wrap it up with this quote from Henry Ford. 100 years ago, he said it very eloquently. You can take my factories, burn my buildings, but give me back my people, and I'll build the business right back again. And I think that, even though technology has made huge inroads into almost every company, right now we're finding is how do you make everyone happy and keep your business running? And it's a huge challenge. This is what we do all day long to help companies identify the ways to attract, reward, and retain. So Brennan, really good recap. I think we'll wrap up our thing. If you have any questions, please feel free to reach out to us. And thank you very much for participating in today's webinar.